With the case study Killing in Action, we are diving even deeper into the various financial elements that are available to us today to finance content, and that is film and or television content. We're adding to our financing elements mezzanine loans, we're adding profit participations, we're adding waterfalls, we're adding the various separations between take and ask pricing on our sales estimates. So we're going more into what really the reality looks like out there. So again, walk through it slowly, see if you get stuck, where you get stuck, and if you have a question about something, and then feel free to email me through Canvas. Enjoy. When you discuss your project with a sales agent and you tell him, here's my script, here is my envisioned talent, here's my budget range, and so forth, he will put together sales estimates that look a little like this. You see every territory listed, and you see them listed in two pricing levels. The take level, which is our lower level, which is the level that investors and banks look at, and then the ask level, which is the medium to high level. Those are the pricing levels the sales agent will lay out for you. In many cases, the pricing that is going to be achieved with the sale that's happening to these foreign distributors is somewhere between the take and the ask level. In our case here, we are establishing that our take pricing level will get us $11,287,500 in revenues from foreign distribution, and the ask level would get us $16,931,250. When we put together our finance plans and we say, for example, that 75% of the budget should ideally be covered with international sales, we really talk about projections. We talk about what the ideal projection should look like, what the ideal sales estimate sheet should look like that we're getting from the sales agent. And when we say 35% of that should be pre-sold, it's an ideal level, but it's in reality a little different, because what you're actually seeing to be sold and what the sales agent is actually selling are these countries. And you see here in the pre-sold column, these countries show as sold. So we're selling Australia, we're selling Benelux, etc., etc. You see those countries are sold, and they're being removed from the take level and from the ask level because they're no longer available to be sold. When they're sold, they're sold. They're no longer available anymore. In our case, we're assuming that the pre-sales happened in the take level pricing. So total pre-sales we have achieved is $5,295,500. Let's look at our scenario for our project evaluations, our projections, and our revenues. We first look at our international sales estimates at the take level, which are listed at $11,287,500. And of that, we actually established some pre-sales to distributors, and we were able to sell some territories totaling $5,295,000. So if we remove these territories from our sales estimate sheet, we will end up with unsold rights that we still can sell for $5,992,500. So in addition, we will be hoping to sell the US, and we know that's going to happen after the movie was finished, for $5 million. So all in all, we would be looking at worldwide gross distribution revenues of $16,287,500. Now let's look at our bank loan. What does that do? Now, from our pre-sales that we have established by selling various territories to distributors, the bank will take these contracts under consideration, but will only give us 80% of the number of all contracts together. So all our pre-sales will be applicable to an 80% discount rate.
So from our pre-sales of 5 million and some change, we will be seeing 80%, which is exactly 4,236,000 from the bank as a pre-sale loan. Now the bank knows that of our pre-sales, we already received 20% from our distributors because the distributors gave us an upfront payment. They give us 20% when the pre-sale agreement is signed and executed, and they will give us 80% when we finally deliver the movie to them. And when we do a bank loan, they're not actually giving us the 80%, but they're giving the 80% to the bank so that the bank's loan is going to be repaid. So the bank knows that we already received 20% for the pre-sale amount and will deduct it from our loan amount. And when we get the pre-sale of 1,059,000, the pre-sale down payment of 1,059,000, we also have to pay our sales agent fees and expenses, together 16%. So that would be 169,440, and we have to pay that because we are receiving the down payment from our distributors. So whenever we receive money from our distributors, a payment to the sales agent is due. And because our sales agent did not agree to defer any payments or any expenses, we will have to pay him. So of the 1,059,000, we end up getting 889,560 to then be used to cover our production budget. Now let's look at what we are left with for a gross pre-sale loan. That would be 3,177,000, and the way we get there is we are taking our 80% pre-sale amount of 4,236,000. We are deducting the money that we already received, which is 1,059,000, and we end up with a gross pre-sale loan amount of 3,177,000. The bank will now apply interest on this gross pre-sale loan of 5%. 850,000 are now deducted as they are being set aside, so to speak, at least on paper, because we're not actually paying them right now. We're paying the interest later from our revenues, but the bank will charge them and they're going to let us know how much it is. And they will deduct from the 3,177,000 the interest of 158,850, and leaving us with a net pre-sale loan amount of 3,018,150, and that's what we're going to get later to fund our movie. Now when we look at the GAAP loan, we always look at the rights that we haven't sold. In our case, that was a value of 5,992,500. Now the bank will look at that collateral of these unsold rights and will only ever consider 50% of that, which in this case would be 2,996,250, and that's our gross GAAP loan. Now of that, we have to pay interest of 9%. The interest here is higher because this is an unsecured loan, because there's no contracts really going against it. This is just the bank hoping that we will sell the unsold rights. So 9% interest is due, that is 269,666.50. So that leaves us with 2,726,587.50 for our net GAAP loan. So if we calculate those two net GAAP loans, those two net bank loans together, the net GAAP loan and the net pre-sale loan, we get to a loan amount of 5,744,737.50, which is the money that the bank will give us. What we have to pay the bank back later is the gross bank loan that includes the interest, which is 6,170,250, because we have to now pay the interest in the revenue stream.
Because the bank has discounted our pre-sales and we want to make sure that our equity investor is not at risk, we're adding a mezzanine lender. So this mezzanine lender is giving us 10% of the budget, which is 10% of $15 million, is $1.5 million. The interest that the mezzanine lender charges of 8% is being deducted up front, so 120,000 will be deducted, and what we will have available to finance our movie is $1,380,000 from this mezzanine loan, which is also referred to as a junior loan because it recoups behind the senior loan, which is our bank loan. Like with any strong finance plan, the idea is very often to include finance elements which we don't have to pay back. Production incentives are a great example for that. The way this works is that the production incentive that would be provided to us after we shot our movie in an incentivized region that would pay us is going to be cash flowed to us by an incentive lender before we even start shooting. So how that works is the production incentive that we are estimating to be receiving based on our budget is going to be shown to an incentive lender who will then agree to advance this incentive to us against a fee. And this incentive lender would not be repaid by us, but would actually be repaid by the incentivizing region. So what this means for us is we can use the production incentive to finance our production cost, and we don't have to pay it back. The incentive lender will take care of the repayment through the region. So in our case, for our movie, we are looking at $3,750,000 as an estimated incentive for the expenses that we will be having in the region. The incentive lender is charging us a 15% fee, deducts this fee, which leaves us with a net incentive loan of $3,187,500.
Summing all our finance sources together, which is our down payment from our distributors, our bank loan, our mezzanine loan, our production incentive. If we sum all these funding sources up, we end up with a subtotal of $11,201,797.50. We have to cover $15 million because that's our budget. So the equity, in order to reach this, will give us the balance of $3,798,202.50, which is about 25.32% of our budget. So let's look at all the finance sources again. We got a bank loan of 80% of our pre-sales. The bank deducted the down payment that we already received for these pre-sales, which is 20% of the pre-sales. And we have to pay our sales agent a sales agency fee and expenses. So right now we are receiving a down payment of $1,059,000 minus what we're paying the sales agent, so we're getting $889,560. Now the bank will look at all our agreements and they look at the unsold rights and they calculate what they are willing to lend us. So a net pre-sale loan of $3,018,150 and a net gap loan of $2,726,587.50 is given to us by the bank. We also get a junior loan of 10% of the budget, which is $1,005,000. We pay our interest for that. We end up with, sorry, it's $1,005,000, and we end up with $1,380,000 because we are deducting $120,000 in interest. And then the production incentive was listed as 25% of our entire budget. In this case, our entire budget is eligible as an expenditure, and we have to pay the tax incentive lender a fee of 15% upfront, which leaves us with $3,187,500. And altogether with production incentive, the mezzanine loan, and the bank loan, we end up with $11,201,797.50 and have an equity investor providing us with a balance of $3,798,202.50. So now we can go make our movie. So we made the movie and it's now time to cash in our revenues. So remember, we had pre-sales of $5,295,000. We had unsold rights that we now sell of $5,992,000, and we have our US distribution of $5 million. Now we did get the down payment already and used it, so the distributors are not going to pay that again, so we have to deduct it here. The $1,059,000 is being deducted from our revenues for that reason. So we're left with altogether 15,228,500 in revenues from worldwide distribution. Now, the next thing that happens after we received all our revenues is we have to figure out what do we have to pay, what expenses are due, what are the loans we have to pay back. So first in line that we have to pay here is our collection agent, who receives 1% of whatever hit the collection account. Next in line is our sales agent, who receives 16% of, in this case, international sales only, because we have a US agency doing the 5% for the US rights, and that's $250,000. So the US agent, it could be a talent agent, CAA, UTA, ICM, you name it, they sold the US rights for us and they get a fee of 5%. So we have to pay that at this point, and that is 5% of 5 million, because that was our US rights. And then the 16% is based on the international distribution revenue portion. The bank loan is 6,173,250. Our junior loan is 1,500,000, and now the premium is due of 150,000. The equity is due of 3,798,202.50, and a 20% premium is also due now of 759,640.50. So altogether our expenses come to 14,419,938. And if we take all our expenses and deduct it from all our revenues, we are left with net profits or net revenues of 808,562. And after we paid everyone, meaning all our expenses, our lenders, our equity investor, all the premium associated to all these investments and loans, and all the interest that we have to pay, we end up with a net revenue of 808,562. And this is the time where we have to share in these profits. So net revenues, meaning net profits, are now the number that is the basis for sharing with our cast and our director and our equity provider. And at this point, we're not paying them in a ranking position like we paid our expenses. Here, everyone gets paid at the same time, pro rata to what they're getting. So when there's 100% coming in, 100% being 808,562, of that 100%, 20% go to the equity investor of 161,712.40, and 40% of that 100,000 go to cast and director, which is 323,428.80, and the balance, which is another 40%, stays with the producer at 328,428.80. So here's a little tip on your assignment, because your assignment would be, what would be the revenue for the producer if you take the same case study and you assume that the ask sales estimates are applicable. Everything else is the same. You have the same pre-sales, you have the same mezzanine lender, you have the same incentive. You're just changing your ask level when it comes to the unsold rights. And here's why. Your international sales estimates, the total ask international sales estimates, are listed at 16,931,250. You pre-sold a list of territories, you pre-sold certain countries, and they come to $5,295,000. What you don't do here is you don't take international sales estimates of 16,931,250 and just deduct 5,295,000 to get to your unsold rights, because that doesn't work here. The fact that you have defined pre-sales that are defined countries, that means you have to remove these countries from your ask sales estimate sheet, because these countries were sold, or pre-sold in this case, on the take level. It doesn't matter that you had them listed in the ask level as a pre-sale number. They were sold at a lower number and they're now gone. You don't have these rights anymore. It is irrelevant what the value was before you sold them. You sold them, and you sold them for $5,295,000, and you now don't have these rights anymore because you sold a finite list of countries, of territories, and these countries, territories are no longer available for you to sell. So if you remove them from your estimate sheet, you end up with 8,988,750 in the unsold rights that you still have available to sell. So keep that in mind when you run your calculation for your assignment.